Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the last weekly economic review of 2023. The next 2 weeks will be holidays, so the next review will be somewhere around mid-January. But this time let's review the weekly action for the week ending December 21st, and let's recap a very interesting year 2023 and look forward for 2024. So at the close on Wednesday, after 3 days, again positive returns for the bond market, mixed for equities and mixed, let's say, for oil, Canadian dollar, euro, and gold. But if you look year to date, it's very deeply in the black, so very strong week here. This week, the market action was again centered around the expectations around what the Fed will do in 2024. We'll get to that in a few minutes. But also locally, it was the Bank of Canada and the inflation report. So inflation is stuck at 3.1%. It seems that it was much easier to bring inflation from 8 to 3 than it should be to bring it from 3 to 2 because of the resilience of inflation. More on that in a few minutes, but we're starting to get in that zone where maybe it's going to be harder. But we did hear from Governor McClellan this week that, their forecast that the first half of 2024 could be tough for the Canadian economy, but they are expecting to cut rates in 2024. So now it came from the horse's mouth, as we would say. So it goes in line with the scenario that we've been working with for a good while. Some rate cuts are coming next year. How many and when? That's the big question. More on that in a few minutes for sure. So if we look back at 2023 here very, very quickly, we see that it was almost a complete reversal of 2022. The bond market did not catch up with all of the losses of 2022. Interest rates rose very quickly last year. So of course, you can catch up all of this in a single year unless there's a recession and all of these things. But still very positive for bonds. For equities, we did make up for most of the losses of 2022. We're not back to all-time highs yet on the S&P 500, but flirting with it, let's say. So we're surprised by the strength of all of those returns. We were expecting somewhere around 7% for the TSX in 2023 at the beginning of the year, somewhere around 5% for the S&P 500. And of course, we were dead wrong with the call on US equities, 25% almost on the S&P 500. 40% plus for NASDAQ, so very strong year here. Now let's see what 2024 has for us. Valuations will be very important. The recent optimism around a soft landing scenario combined with multiple rate cuts by the Fed has been pushing markets higher recently. Let's see if it makes sense. Let's see if the market is set up for negative surprises in 2024. But for now, let's enjoy those returns here. In absolute returns, balanced portfolios produced a very strong year this year. So let's enjoy it. Main macro stories of 2023 now. I picked a few. The first one, of course, it was tightening of monetary policy and the fight on inflation. So, of course, the coordinated tightening of monetary policy was the feature of 2022-2023. Now, likely we're done with rate hikes. There might be arguments for maybe a few more left and right, maybe like in Australia, like recently there was a rate hike. But I think if we're look at Canada and the US, even though there's still this language used by central bankers that they're open to hiking again, likely we're done and likely the next move will be a rate cut. The question is when. And when you look at the inflation chart on the right, it's interesting. It's interesting to see how, in the end, inflation was transitory, like central bankers said, but maybe it was not packaged correctly because transitory meant 3 years here. So it's still a long time, but going all the way to 8% and back now to 3%. The fight on inflation is working, but now the question is how quickly can you cut so that you make sure that you bring inflation back to 2%. Higher for longer should be the case here. Likely we'll have a few cuts in 2024 because now central banks have both feet on the brakes. should start by removing at least one of the 2 feet here. Does that mean 2, 3, 4 cuts in 2024? Maybe. Does that mean that we will reverse this thing as quickly as it happened? Of course not, unless we have a strong deterioration in the economy and central bankers have to act quickly. So the picture here is very interesting. In 2024, central bank action and inflation and everything that goes with the wage pressures and the labor market and all of that will be very important to follow next year. The other story of 2023 was how the economy was almost constantly revised higher with a more positive view for 2023, especially in the US. The US economy kept surprising positively. A lot of that has to do with, of course, the resilience of the consumer, but also the growth in the deficit in the US. So we've been borrowing from the future to grow the economy in the US. Interestingly, if you look on the chart on the right, well, it kind of saw during the year that for most countries, the revisions were lower for 2024. So yes, stronger growth this year, but maybe at the cost of weaker growth next year. But it was a pleasant surprise this year to see how well the US economy held. Let's see now what 2024 brings. If the US economy continues to grow its deficit, and at some point, it will run into some long-term issues. Already, the forecasts are pretty dire for the cost of debt. Well, at some point, you have to make those hard choices, and in 2024, we could see some of these hard choices. At first, maybe the deficit will stop contributing to growth, and after that could weigh on growth. So the setup for 2024 could be a bit more fragile. Other story of 2023 was when will we see the first rate cuts? Here you have 2 charts. On the left is the Fed, on the right is the Bank of Canada, and it's the number of cuts that are priced by the markets for most of the decision dates in Canada and in the US for next year. And now, as you can see, the number of cuts that are priced by the markets for late 2024 is about 5 to 6, which seems aggressive. The first rate cuts are priced in somewhere around March, or let's say late Q1 or in Q2. Also, this might be an aggressive forecast here, given how resilient the inflation is here, and given the message that we're hearing from central bankers. So the point here is that you kind of have to pick your scenario. Either you think that you have a soft landing in the US, the economy holds still, and if that's the case, well, there will still be some wage pressures that are inflationary that will be lingering around, and the Fed will not be able or willing to cut as quickly as what's priced here. Or the economy deteriorates much worse than expected, and then the Fed is forced to act with these many cuts here. But you can't have both. That's kind of the message here. So markets might be priced for perfection as we end 2023. Momentum has been very strong recently. Sentiment is near extreme levels right now of optimism. So again, the point of valuations mattering in early 2024 is very important. So market might be surprised by the combination of economic data and what the Fed, this entails for central bankers. Bring some volatility, but the setup that we're seeing right now, it's I would say that it's a big bet that we're seeing from markets. The other story of 2023, the last one that I'll cover here, was China. And China, there's always been this saying that there's a risk for China to get old before it gets rich. And it seems that 2023 is the year when we have the confirmation that China got old before it got rich. And China, of course, when the Chinese economy reopened its borders in early 2023, we were of the opinion that the timing was not too good for China, because as it reopened its borders, the world economy was starting to slow down. So the clients for the manufacturing sector in China were downsizing at that moment, and we did have a bit of a letdown from Chinese economy this year. We learned the extent of the leverage problems that there are in the Chinese economy. The property sector was front and center, but also the municipalities, which have some issues with debt. in China were in focus, and the plan now is to deliver the Chinese economy to make sure that they don't have some debt issues that could become systemic, and of course this comes at a cost of long-term growth. The Chinese strategy of stimulating the economy with short-term stimulus now seems to be off the table. Could always come back, but now we see that the Chinese economy has lost some of its impulse, and it's losing help from growing demography. Even with the removal of the one-child policy, we still see a birth rate that is falling at very low levels. So you see here the dependency ratios in the future will be harder and harder for China to handle. So I'm not a China expert by any measure, but all of the China experts that I read say that in 2023 we got the confirmation that China might just have missed its window to one day become the biggest economy in the world. So that means that China will be contributing less and less to global growth as we move forward. So it's one of the let's say of the legs of the stool that is getting a bit shorter here. So China will contribute less to growth. That's a very important story here for 2023. Now, if we look at 2024, the story of the year will hang on the labor market, and we're starting to see the unemployment rates rise. Now on the left you see the chart. When this starts to happen, very rarely does this happen just for like 1%, and then after that we have a turnaround lower. Usually these movements have legs, so let's see if that's still the case in 2024. And on the right, mentioned that a few times this year, the SAM rule on timing of recessions. This is something that allows us to guess in real time if there is a recession or not in the US, and likely somewhere in early 2024 we could see a signal happening from this rule saying that all right, officially US economy is in a recession. So how will markets react to that? What will that mean? Well, that will be a very interesting thing to follow in 2024. So if you take all of the macro factors here together and you look at the behavior of global stocks to bonds on the next chart here, you see that markets are looking at 2024 with ample optimism and could have become disconnected from macro fundamentals. Here, so the blue line is pretty much the global business cycle, and the gray line is the global stocks to bonds ratio. And typically, they don't always tend to go hand in hand, but the turnaround points tend to coincide pretty well. And now we're seeing the global economic cycle that's maybe making a base here, but you see that in the short term at least, it seems that the stocks to bonds ratio has kind of made a peak. So that suggests that we could see an outperformance of bonds over stocks in the short run as this normalizes. So as the macro fundamentals reconnect with the markets. So looking at 2024, there's an argument to be made here that bonds could be in a good position to perform well compared to equities, at least based on this convergence with the macro fundamental that should happen at some point. We can always be surprised, but generally these things tend to reconverge at some point. Another argument for maybe an outperformance of, let's say, global ex-US stocks or bonds versus stocks is in the US, 2023 was the year that artificial intelligence went mainstream. ChatGPT, the buzz that was created earlier this year, of course, pushed the prices of the what we call the Magnificent Seven, which are large companies with good revenues, but still the performance this year was very strong, about 75% for these 7 names. How does that set up 2024 here? Could we see sideways action from these names, profit taking, rotation to other sectors, which would lead the index to pretty much stay in place for part of the year? So the dynamic between the reality meeting expectations on that team, the pricing of these sectors, these names compared to other sectors in the US, will be determining factors for what we see in 2024 on the US stock market. So it would be surprising to see another year where these names continue to contribute like that to the index. Maybe we'll lose the contribution of these names through the year. So it's an interesting setup again for early 2024. So valuation will be very important, will be key. Choosing the right names, choosing the right sectors, choosing the right indices, the right geographies. 2024 is how you will be adding value. So valuation arguments in 2024 should be key here. Finally, bond market, volatile year ending on an optimistic note. Rates lower at the end of the year here as markets are pricing in rate cuts for 2024. Let's see where that brings us, but still it's interesting to see that you still have a cushion on the interest rates. There's still room for capital gains if we do go into a negative scenario. The negative data dominates and we have rates that fall. So there's still this element of the market that's interesting on the left. And for the corporate spreads, some optimism recently. It's important to pick your sectors, to pick the names carefully. High yield might be still a bit expensive if we do go into a recession scenario. Investment grade, recently the spreads have come in a good bit, but as you can see, there's still some interesting value to be had here. Again, we could have some volatility. There's been ample volatility in rates and fixed income this year. Could continue, but at least we're ending on an optimistic note here, and there's still an argument to be made for fixed income to be a good contributor to performance in 2024. So what to watch next week in Canada? We'll have Bloomberg Nanas Confidence Survey. We'll have the CFIB Business Barometer. In the US, we'll have a few things about Hysing, so two price indices, the pending home sales. We'll have also the jobless claims figure. So thank you for following us through the year. It's always a pleasure to serve you. You can find us at ia.ca/economy, on iagam.ca/insights. We'll be there again with this weekly review through 2024. The next meeting that I'm setting here is for somewhere around mid-January, so enjoy the holidays, and I'll see you again next year.